India's consumer price index based inflation for the month of September surged to a 5-month high of 7.4%. This inflation print officially marks, for the first time, the failure of the RBI MPC to keep inflation within the mandated target range. Since May this year, the central bank has raised the repo rate by 190 basis points to rein in persistently high inflation. The repo rate is currently at 5.9%. However, the latest inflation data will likely warrant more rate hikes and a shift away from surplus liquidity conditions in the banking system. The picture on growth is also not rosy. In September, the RBI reduced its FY23 GDP growth forecast to 7% from 7.2%. A number of global institutions, including the IMF and the World Bank, have also lowered the country's growth forecasts. Since higher interest rates depress aggregate demand in the economy, the extent to which the RBI is willing to go to tame inflation could either support growth or prove to be an impediment. Against this backdrop, two external members of the MPC have expressed concerns about fragile growth, calling for slower rate hikes. Stating that monetary policy acts with a lag, Professor Jayant R. Verma has called for pausing at a repo rate of 6%. In the recently released minutes of the September MPC meeting, Verma said that it was dangerous to push the policy well above the neutral rate in an environment where the growth outlook was very fragile, and called for a pause after the September hike. Verma said that India had seen unacceptably low levels of growth for longer than it had seen unacceptable levels of inflation, adding that going beyond 6% would compromise the second part of the MPC's mandate to support growth. Verma voted against the resolution to remain focused on withdrawal of accommodation to keep inflation within target.
I believe that in another quarter or two, it will drop below the 6%. So in a couple of quarters, we should be in the ballpark range of 5. That is absolutely essential. You bring inflation down by pushing growth down. The MPC has to balance these two mandates, inflation and growth, and ask how much pain do we want to inflict on the economy versus how quickly do we want to bring it down to 4%.
There are reasons to be sanguine on the inflation front.
Based on the current trends, I would like to assume that the worst is behind us. So if you look at the inflation drivers, it is largely the global commodity prices. So if you look at the last 2 months, some of the commodity price inflation is in a negative zone. So to that extent, I would say that inflation is behind us. In fact, I was on record to say that it has actually peaked in the month of May 2022 when it reached 7.8%, and we should be stabilizing at 6% soon.
The other MPC member, Ashima Goyal, said that high repo rates imposed heavy costs on India in 2011, 2014 and 2018, leading to a credit and investment slowdown. She added that it was necessary to proceed very carefully now that forward-looking real interest rates were positive. Goyal was the only member who voted against a 50 basis point repo rate hike during the September policy. Instead, she had pitched for a 35 basis point hike. She told Business Standard recently that India's real interest rate should not exceed 1%. Going by the MPC's inflation projections, this would imply little room for further rate hikes in the current tightening cycle. On how the MPC could minimize the impact on growth while still achieving its inflation target, Goyal said,
I think Indian monetary policy was too much in stimulus just after the global financial crisis, and then there were double deficits and various fragilities, so it became too tight. There was overreaction. And this is what we are seeing the Fed do now. There was too much stimulus after COVID-19 and overreaction now. And we are seeing a lot of problems in financial markets abroad. Yeah. So I think moderation is a lesson that perhaps Indian policy, monetary and other policies have learned to be counter-cyclical, not to let the real rates become too negative or too positive. And as long as we have the policy space to do these kind of adjustments, and as long as we do that, I think we will be able to bring down inflation. Also with monetary fiscal coordination, because there is a lot of fiscal action possible on the supply side. For example, the government targeted free food provision is one reason why wages have not risen. And in the 2010s, we had second round inflation because the rural real wages were rising in double digits almost. Today they are flat. right? So we don't have those kind of pressures today. And we have the policy space to both moderate inflation without hurting growth too much.
However, there are two sides to this debate. The MPC minutes show that RBI Deputy Governor Michael Patra has said that monetary policy must shift to red alert because not only are inflation expectations rising, there are indications that they are becoming unanchored over a 1 year ahead horizon. According to Patra, inflation has become unyielding and tightly range-bound around the upper tolerance band of the inflation target. The IMF expects average retail price inflation in India at 6.9% for 2022-23. IMF's India Mission Chief Nada Choueiri too believes that inflation will not come below RBI's tolerance level in FY23. She said that the IMF projects significant momentum in prices and doesn't see inflation falling below 6% in FY23. However, she added that the agency expects it to fall below 6% in FY24. It is clear that during the September policy, sharp differences in opinion emerged among MPC members, with some asking for restraint on future rate hikes, while others continued to call for aggressive action. This will make the next review of the Monetary Policy Committee, scheduled in the first week of December, an interesting event. Overall, given the large number of uncertainties on the global stage, it's likely that more challenges on both the inflation and growth front could emerge.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.